Good afternoon. Thank you for joining us for our second day of Combine and Conquer, Antitrust Regulation, and how it affects mergers. Today we have Dr. Thomas Hazlett, Professor of Law and Economics at George Mason University. He'll be speaking on the XM-Sirius merger debate. But before I introduce Dr. Hazlett to you, there are a few forms before you. The first one is the blue sheet. That is our survey that we hand out at every course. If you would please take the time to fill that out and hand it to one of my colleagues as you leave today, we would appreciate it. We do use the comments that you make to improve our courses, which leads me to one of the second sheets in front of you, some upcoming programs we have for this next month. First, next Friday, we have Dr. Bruce Yandel talking about the quarterly economic update. It's a regular. The week after that, we have updating the federal budget. And the next week after that, we have a course on sovereign wealth funds. This one's actually based upon some comments made in some previous surveys. So we're here trying to provide you what you need to do your job here on the Capitol. And then finally, the first week of April, we have discussions on monetary policy. Dr. Thomas Hazlett received his PhD in economics from UCLA and has previously taught at Columbia University in New York and the Wharton School of Business at the University of Pennsylvania. His area of expertise is telecom law, and he has written numerous articles and has also given testimony before congressional panels and agencies, and also as an expert witness for courts. Okay. With that, will you please join me in introducing Dr. Hazlett.
Thank you. Apparently the food has been good enough at each of my previous talks here for Mercatus so that people keep giving me good recommendations on those surveys. And I get invited back. So it is March, so I'll probably be preoccupied. Of course, my thoughts are elsewhere. Having grown up in a UCLA household, we get ready for March Madness, and we're ready this year. Our team is doing pretty well, and I'm going to be up till 1 o'clock this morning watching the UCLA-Stanford game. Being on the East Coast is very tough when you're a UCLA fan, but if you're dedicated, you can hang with it. And fortunately, thanks to regional sports networks that are massively carried by DirecTV, I'm able to keep up. I'm glad to be here at Congress today. Yesterday, my daughter is 9 years old, went with her fourth grade class to see what was happening here in Congress, to watch you folks and your colleagues. And I asked her what was going on yesterday in the Congress, and she was quite excited to tell me that there was a big debate over renaming a public park, and then a rather more heated debate having to do with a holiday in Minnesota for Hubert Humphrey's daughter. And she didn't know how this was resolved, so maybe you can fill me in later. But she was quite impressed by her government at work, by the way. And so you have a bunch of customers in the fourth grade out there in Maryland. Okay, I've been asked to talk about mergers, and specifically about the XM-Sirius merger. And I'm happy to do that. I think it's particularly interesting. The merger was announced February 19th, 2007. That's over a year ago by most calculations. It's being evaluated by the Department of Justice and the Federal Communications Commission. The FCC is involved because there are satellite radio licenses to assign in the merger. I wrote 2 white papers on the merger at the request of the parties, XM and Sirius, that is. And these were filed with the Federal Communications Commission. They're public documents. If you have trouble getting a hold of them, on the excellent FCC website, I say that facetiously, you know that the FCC blocks Google and its crawler from organizing the FCC website so that you can actually search it? You folks in Congress ought to know about that. Anyway, if you have trouble getting a hold of them, please don't hesitate to send me a note. I'm happy to provide. There is an FCC page, by the way, that does have a lot of these documents listed and that is organized well. When you find that link, it's organized nicely. And obviously it doesn't have just my white papers, but a lot of other stuff, a lot of stuff filed by people opposing the merger as well as favoring the merger. And so there's lots of stuff there. I'm happy to provide those links if you're interested. You may have seen the tirade by Kramer, who was very upset about the merger and the fact that it's taken over a year, and he went on the Jimmy Kimmel show. So this is on YouTube. If you want to go search Kramer, he gets up and starts stomping around about how he's going to be taking names about the folks in Congress that he's blaming for this delay, because it's something that he thinks is a no-brainer and ought to go forward. Perhaps there's a little bit more debate amongst the regulators than Kramer went into on Jimmy Kimmel, but the real debate in most of these merger cases, as you probably know, comes down to what's called market definition, drawing a line around the products. In this case, the geographic space is probably a national market, so that's not a big issue. I'm referencing, of course, the fact that there's a product definition and then a market or geographical definition, the latter being uncontroversial in this case. But the product definition is quite controversial, and in fact, most commentators think that the decision by regulators, certainly in particular those at the Department of Justice Antitrust Division, that's handling approval or disapproval of the merger, is going to ride on how the marketplace is defined. So the principal question here is, does satellite radio, XM and the Sirius products, services, do they compete with terrestrial broadcast radio? And while we're at it, we should ask about these other products, these other audio products like MP3 players, internet radio, things like media flow, emerging products there, other things that can get you audio to devices, particularly devices in your car, where the majority of AM, FM, or satellite radio listening takes place. So, if terrestrial radio competes, just to pick out one of these possible competitors, if terrestrial radio competes with satellite radio, then you have a fairly straightforward approval of the merger on the grounds that satellite radio is a very, very small part of the radio market. Including terrestrial radio means that you're going to be looking at something like 14 million satellite radios. These are numbers as of the end of 2006. There are more current numbers, but I'm using the stuff that was in my white papers. 14 million radios versus some 240 million automobile AM/FM radios. Of course, there are a lot more radios than that, but in fact, the total number of AM/FM receivers in the country is not well documented. Households certainly have multiple receivers on average, but just talking about the and limiting terrestrial radio to car reception, you have 240 million cars, virtually all of which do include AM/FM receivers. About 14 million of those cars also have satellite receivers. You talk about revenues, a common way to compare market shares in merger cases or other antitrust actions. There's about $20 billion in annual terrestrial radio revenues. That's advertising, of course. About 3/4 of that is local advertising, by the way, about 1/4 being national advertising. And there's only $1.6 billion as of 2006, only $1.6 billion in revenue total for XM and Sirius. So you're talking at least an order of magnitude more revenue for terrestrial radio. And then if you look at enterprise values, the total value of radio stations in the U.S. versus the total value of XM and Sirius, you're talking something on the order of 10 to 1. By my calculation, the total value of the U.S. radio industry was about $80 billion in 2006 versus about $9 billion enterprise value for the two firms when the merger was announced a little over a year ago. So if you draw the line to include terrestrial radio, you certainly have a decision in favor of the merger in the sense that there is plenty of competition In fact, the overwhelming majority of the market, that is to say the choices made by customers for radio services or audio services, audio entertainment services, the majority of those decisions involve other products, competing products, substitutes. If on the other hand, terrestrial radio and these other products are not in the market, then you come down to a situation where you are defining the market narrowly to include just XM and Sirius. That would be, therefore, a merger from 2 to 1. And most people think that the antitrust authorities would not be in favor of such a merger. And in fact, opponents of the merger, for instance, those at the National Association of Broadcasters, do make the argument that the merger is a 2 to 1 merger, and they call it merger to monopoly. Merger from duopoly to monopoly. Okay. So that's just sort of the general way that comes out. One way we might think about this is at a high level to first start with what we call a common sense test. I think that's self-explanatory. Just ask the question, do you think consumers substitute between these products? Are the prices that can be charged by satellite radio, are they constrained in a fairly important sense by the availability of substitutes? I think the logical answer to that question is yes. Consumers certainly do substitute between these products, and I think that there is evidence for that. Again, you may think I'm biased in favor of the merger, and you would be right. I am biased in favor of the merger. That happened before I was retained to write those white papers, in fact. But I think the evidence is clear. In fact, survey evidence shows that when people obtain satellite radio service and pay their $12.95 a month for that, they tend to then listen to less AM/FM radio, not at all surprising. On the other hand, satellite radio subscriptions tend to run higher. That means to be more numerous in areas where there are fewer over-the-air radio stations. So there's other evidence we can look at, but those are directly slanted towards that question, answering that question, is there substitution between these products? And I think it answers the common sense question. Obviously, there's more analysis that can and should be done, and the antitrust agencies are very formal in the way that they process the information. And the standard approach is to consider a so-called snip test, and that asks this question. What would happen if the merged firm, after the merger, were to impose a small but significant non-transitory increase in price? So, two firms merge. The merged firm looks out to the marketplace with changed conditions, and it attempts to raise price. What's going to happen? Obviously, things might be a little different post-merger. It's the whole point for an evaluation. Things might be different because there might be lower costs. That's one of the reasons firms merge. And they may have incentives to actually decrease price to get a larger number of unit sales because of their lower costs. On the other hand, they may have excluded some important competition. There is one less substitute product because the merger's taken a product out of an independent product out of the market. So now the firm may have greater market power, be able to raise price, and relative to what would have happened otherwise, and make profits that way. So this is the basic analytical framework that the Antitrust Agency uses, and I say Antitrust Agency, it's the same general procedure at the Federal Trade Commission. As you probably know, the DOJ and the Federal Trade Commission divvy up these cases on a negotiated basis and, in a sense, take turns running this similar analysis. The analysis at the Federal Communications Commission, to the extent you're interested in that, is a parallel investigation, and nobody quite knows what the standards are. Those obviously run under the public interest standard, not under a competition standard, and so they tend to be a lot looser in terms of what the FCC can look at. In general, however, the Federal Communications Commission does want to, in essence, duplicate what the antitrust agencies are doing at least at a fundamental level. There may be other things that they look at, but fundamentally they do want to answer these competition questions. There have been books written quite critical of the FCC because of the fact that these merger investigations tend to be quite duplicative. Discussion for another time. Okay, so when answering this question, of course, the correct answer is, well, it depends. And what does it depend on? It depends on how, specifically, consumer demand changes relative to the merger. We could also talk about the cost side and the incentives of the firm to actually expand output because of lower costs. I'm going to set that aside now and just focus on this consumer demand issue, which is quite central. And specifically, we're really trying to find out, is demand becoming what economists call less elastic? Is demand now less sensitive to a change in price for the obvious reason that after the merger, there is one less competitor. There's one less substitute. So when prices go up, consumers have one less opportunity to make a substitution. If that's an important substitution opportunity relative to everything else that's out there, that might make it profitable for the firm to significantly raise prices. And in general, there are guidelines, benchmarks here. The antitrust agencies generally talk about non-transitory means, say, for over a two-year period or more, can prices go up, and can prices go up at least 5%. By the way, if you have questions, feel free to jump in. So there's fairly simple formulae that accompany this question and enable people to answer it in quite specific terms. The problem is that to fill in the blanks in the formula, you need lots of information. In the absence of that information, which is almost always lacking at some level, you have to make some assumptions. And those assumptions actually tend to be quite important and highly restrictive. And therein, of course, lies the problem. And one thing that always tends to be a problem is, before merger occurs, how are you to observe what the post-merger demand conditions are? So how do you know how sensitive the customers are to a change in the market structure? Now, there are some particular opportunities that might arise if you have a market where there's lots of entry and exit over time, and you've had 3 or 4 competitors, and you've had other mergers, you've had other firms come in. Those are the sorts of changes in market structure that economists and regulators like to look at, because it gives them maybe some guidance as to what might happen looking forward to another change in market structure. So you argue by analogy and from experience. Well, here in the satellite merger, you have a situation, not all that unusual, by the way, where there really is no historic evidence. There is no opportunity to look at the market changing with respect to just satellite radio operators coming in and out. Satellite radio was licensed in 1997. Both of the operators essentially came into the marketplace in 2001, 2002, after they launched satellites and got their systems up and running. And with respect to a change in that market structure, not a lot of information. Also, the competition between terrestrial radio and satellite radio is quite an interesting competition. If you talk to folks on either side of that divide, they will tell you that they're highly competitive. I'm talking about the operations folks. Okay, so no matter what the National Association of Broadcasters says about satellite radio being in a separate market, and we'll get to that argument momentarily, but if you talk or just read the operations manuals over at the NAB, you'll find, for example, that HD radio has been developed and is now being promoted with a very large marketing budget as per the competitor. Explicitly, HD radio is, as per the broadcaster's position, a response to satellite radio. And if you go, of course, to satellite radio and you talk to the folks there, they will say, look, our whole game is to pull people off of AM, FM, and other MP3 devices and so forth, but particularly AM, FM radio. That's why we go out and we get talent like, for example, Howard Stern. okay, or Oprah. We want to put product on our system that pulls people away from the competitor. Now, one of the interesting things about this is this competition basically takes place in quality space. So pricing is important, and certainly the pricing of the subscription service, satellite radio being a subscription service, has a little bit of advertising, but it's overwhelmingly supported. The revenues overwhelmingly come from this $12.95 a month subscription. Of course, there's no subscription fee to AM/FM. That's free over the air, as is HD radio now. And the competition between the two, according to the operations side of each business, is intense, but it's intense because of pulling product, content, from one or the other, or from some third source, and try to pull listeners away from the other. Okay? So the sad thing about that for antitrust analysis is that price changes are fairly easy to document because they're numerical, and when companies change their prices, you like to see what happens to change in demand or purchases for other products. That's a cross-elasticity estimation. That's what the antitrust authorities try to look for. When changes come in the form not of a price change, but a quality of change, it's the same in consumer terms as a price change. You're increasing quality or the choice or option available to the customer for a given price, but you don't get the same numerical estimate of the change in quality. You can't say that, when price change, you can say that that's a 10% change if it's a 10% change. Quality changes, it's hard to actually quantify that. And that seems like a small point. It turns out to be a very large point in terms of the analysis. Okay, the quality stuff is much harder to track than the price. So here's how this thing sort of sits. Merger opponents in the DARS is a digital audio radio service, by the way. It's a FCC jargon. It's the largest output of the Federal Communications Commission is acronyms, and so this is one, sometimes called SDARS for Satellite Digital Audio Radio Service. So opponents of the merger did their own snip test to argue that after the merger of XM and Sirius, if permitted, after the merger, that the company would be tempted to raise its prices. Currently, both firms charge $12.95 a month. And the question is, if they get together, will they have the market power to raise their price and make a higher profit? Obviously, they could raise their prices. They could raise their prices now. Presumably, today, if they raise their prices, they wouldn't make a higher profit. Okay? They would have already done it. If they raise their prices today, yes, they could get more revenue for the customers who stay, but they'd get fewer customers or lower growth, so fewer customers in the future. And so many fewer, so much substitution away from their product, it would not be profitable. So that's the, as I said, that's the central question that you answer in the snip test there. And the argument that's fashioned by opponents of the merger has been that if you allowed the merger, that the customers would be very inelastic and would not substitute away even in the face of a price increase. And in all the stuff that was written, there was actually one piece of direct evidence that was offered to establish the fact that demand would be relatively low. Elasticity would be relatively low. That is to say, customers would not be sensitive to a price increase. The price increase would stick, and higher profits would result post-merger. And here was the evidence. Spring of 2005, XM, then charging just $9.95 a month, raised its price to $12.95, or 30%. And the assertion by the opponents of the merger was that XM continued to grow. In other words, subscribers continued to grow. Now, the analysis, I don't think, was terribly compelling. That is to say, they didn't really look at the long-run trend and answer the question, would growth have been higher without the price increase? And they didn't answer the most important question here, and that is, was quality changing? And of course, when XM raised the price by 30%, they also added several new services. That's not shocking to you. This is the way firms do this in the market. And so they add a lot of services. So the real price increase was not 30%. Might not have been anything. Maybe the new services were worth more than the price increase to the median customer. But however the analysis went, the allegation was, well, we already have some marketplace experience. This is the one bit of direct evidence we have, and look what happened. Well, obviously customers don't substitute away from satellite radio because XM kept growing at about the same rate, even with the price increase. Well, when I read this, I thought that's an interesting analysis, because what that does is it suggests that XM and Sirius are in separate markets. That is to say, there was no substitution between Sirius and XM. As I said, I have problems with the analysis fundamentally at a numerical or quantitative level, but to the extent that the argument is correct, and this is the argument that's been made, that we have evidence from the real world, direct evidence, about the inelasticity, the unresponsiveness of customers, a condition that allows a merger to profitably raise price post-merger. What it says is that already in the marketplace, XM and Sirius can adjust their prices without substitution from one to the other. So it turns out that this is not a good argument for looking forward to the merger, post-merger world, and saying that the demand is inelastic. Now, you can back up and say, okay, well, this is not a good argument, but there's other stuff. Well, the problem is, as already noted, this is the one bit of direct evidence about elasticity that was presented. And it's very difficult for people to actually run this exam, run this test before the merger. And so we're left to look at other sorts of things outside the SNP test to see exactly where competition takes us. By the way, this gives you an idea of how easy it is to define markets too narrowly with a use or misuse of the SNP test. That is to say, if you're going to ignore quality differences and various dynamic factors where firms are changing other things than price and moving products and product menus around over time, the simple price correlations are sometimes quite misleading, and this is an example of it here. I think that it's wrong that XM and Sirius are in different markets. I think clearly they do compete with each other. In my opinion, they clearly also compete with other products, including terrestrial radio. But the problem is, I think, exemplified by the misapplication of the SNP test. And we just end up, I think, with rejecting that sort of analysis and ending up with very little evidence about what would happen in the market with looking simply at the price data. So the problem in this sort of, we call it a static analysis, just looking at, or comparative statics, looking at a situation pre-merger, saying what the prices are, and post-merger would the prices be higher. All of this assumes that we have an equilibrium situation. Obviously, in many markets, like satellite radio, there's a very large growth component to the market. Firms actually, even the standard formulas used, are known not to be literally correct about forecasting the way firms price, because firms are actually pricing for a medium to long-term opportunity where they'll be able to actually justify the large investments in satellites and fixed costs that accompany this kind of a business venture. And so when firms employ things like penetration pricing, trying to establish a critical mass to get their market, their service established and popular amongst the public, even the standard formulas are known not to be completely accurate. So this makes all of this analysis very difficult. So I think, and I have some confidence that the antitrust agencies agree that it's very, very important to look at other evidence beyond these standard laboratory, or I should say classroom or chalkboard types of analyses. Not much of a laboratory because we don't have much to experiment on here. But some other information may actually be much better to look at. And what else is there? Well, there's financial valuation data, looking at financial markets, what they can tell us about how markets are defined. Also looking at financial markets for share price reactions in what are called event studies. We'll talk about those in a second. And then finally, merger positions of interested parties, people who oppose or support the merger for economic interest reasons. First, let's look at financial valuations. Financial markets actually, in a very important sense, tell us a lot about where markets exist and where they don't. And here in the satellite merger case, we have a good application of this. That is to say, opponents of the merger say that there is currently a duopoly in satellite radio, and a merger would take the firms to monopoly. Okay? Now, one testable implication of this is that the small numbers competition is going to yield high profits, right? Because we've certainly learned that duopoly and particularly monopoly pricing patterns in the marketplace reveal the existence of high profits. So one correlation here should be that if in fact the market definition is correct, satellite radio is its own market, then the market should have reasonably high profits, and the anticipation, and we know something about what the value of XM and Sirius is as a merged entity because they announced a merger and prices went up, share prices of the firms went up. The probability of merger even at that point was not 100% because of the approval process, but we have some idea of where they would go. Certainly financial analysts have spent a lot of time trying to answer that question. And it turns out that the firms themselves really aren't very profitable given what they've had to spend to be in that market. So the basic idea here is that the value of the firms, we see the value of the stock, the equity, and the value of the debt trading, so we can get the enterprise value, the value of these firms. And the value of the firm reflects all the future earning power of the firm, of course. And it includes any pricing power that these firms might have to raise prices above competitive levels. And this intuition has been used by many regulatory agencies, including the Federal Communications Commission, and just one example of the FCC a few years ago using the market value of cable television companies, capitalized at several times their capital cost, or valued at several times their capital cost, and that was an index of monopoly power in the cable television, the local distribution in cable TV operations. So here is just a basic rundown on what's happened over time in the Sirius and XM marketplace. The enterprise value of the firms as of 2007, about the time of the merger, was somewhere around $9 billion, $4.8 billion for Sirius, that's debt plus equity, and about $4.4 billion for XM. And if you actually run through all the expenditures of the firms and just capitalize them at the T-bill rate, meaning that, well, the T-bill rate is a very low rate because the firms have much higher risk than that, you get something much in excess of $9 billion. If you do what's conservative, actually a conservative but more realistic way to value the firms, you compound their negative expenditures at just 12% a year. At least cost of capital is probably at least 12% a year for these firms, which includes obviously a risk premium. You get about $16 billion being the total cost of their investment. So they've invested about $16 billion or more, and they had about $9 billion in capital value to show for it. What this indicates is that the financial markets think there is no product market here. That is to say that however they price satellite radio, the current subscriber base and the expected future subscriber base has to compete with other products to the degree that they don't even think they'll be able to recoup their capital costs. Now, Of course, the merger could increase these values. It is exceedingly unlikely that the actual market value of the firms would even come up to $16 billion, or the out-of-pocket expense, so to speak, capitalized at a reasonable discount rate in the merger, and certainly solid evidence for that. But this is a duopoly market, according to critics of the merger, who say this is a merger to monopoly. In fact, the financial markets say there's no market here at all. There is no even competitive profit so far to be realized from the satellite radio business. In product space, the way to translate that is to say that when these companies have to go out and sell their product, there's enough competition to satellite radio so that they have not been able to charge prices and attract subscribers that pay off to generate anything close to a monopoly return or a duopoly return, and so far even a competitive return. So this is very important information. I hope that the regulatory authorities look at it when looking at this. And I think that they should take a position that these markets need some positive capital value before we can start talking about lack of competition. Okay, when firms are priced by Wall Street at very competitive levels, it's not likely that they're selling at prices that are above competitive levels. Okay, then we have a whole bunch of interesting data that's generated every second of every trading day in financial markets. It's separate from what we just talked about in terms of market definition, but it gives us some idea of the future effects of mergers as anticipated by bettors betting with their own money. And the bettors, of course, are investors who are trying to figure out the effect of mergers on the future profits of companies, publicly listed companies. And so this is a relatively objective measure of the effect of any particular event. In this case, we're talking about merger events, merger announcements. It could be regulatory announcements pushing a merger back. Either way, let's look at the stock prices of firms, net out other factors that might account for variations in those prices, and then try to discern a return, we call it an abnormal or excess return because it's associated just with this event, net of market effects, a return that's associated with the event in question, in this case a merger, and make some judgments about whether or not the merger is anticipated to be pro-consumer or anti-competitive. Okay? So the way you figure out where the merger actually is causing stuff to happen on Wall Street is by looking at the target of the merger. The target firm is the firm that gets the big run-up in stock price. The acquiring firm, on average, makes just an average return, so there often is even a negative price effect there. Sometimes it's positive, sometimes it's zero. But the real signal on the merger and when that information about the merger is coming into the market is when the target firm actually has a fairly large price appreciation. And then you look over those windows when you can identify, if you can identify that kind of a thing, then you look at what's happening to publicly listed customers of the merged firms or suppliers, vendors that sell into that space. Okay? All these companies generally, in general, the customers and the complementary product producers, the suppliers, they want competition. They would be harmed by monopoly. They don't like restrictions of output that other firms cause. They don't like those high prices that discourage consumers from buying. Now, the rivals in the market, however, do like mergers to monopoly that create high prices. Their stock prices tend to go up because if your rival raises your price, customers tend to substitute into your product. So if these competitive or anti-competitive effects are in evidence, we should be able to discern some of this by looking at stock prices under the right conditions. Okay, what are the right conditions? Well, in particular, you want to see firms which are publicly listed. Private companies don't help you much because they don't sell their stock on a minute-to-minute basis in a publicly listed market. But you want to find publicly listed firms that are pure plays. So if I want to know what's happening with a cable TV merger, what the competitive effect is of Comcast buying AT&T's cable TV systems. I could look at the stock price reaction of General Electric because they own CNBC, which is a vendor or supplier, complementary supplier. But guess what? General Electric's price as a stock has very little to do with the fortunes of CNBC or MSNBC or even NBC, because General Electric's a fairly large conglomerate. So you want pure plays where you see the effect on a particular business. So that's really what you want to look for. You want there's some other things that are very important, but that's the big thing once you get the windows right. And I'll give you an example. A paper I published with an economist at the University of Kansas, George Bittlingmeyer. Das Kapital does do antitrust enforcement actions against Microsoft to create value for shareholders in the computer sector. And this was published in the Journal of Financial Economics in March of 2000. I think this is a great paper. I came up with the title, and George wrote the paper, so it was about 50-50 on inputs. And trying to get him to write another paper. And I'll come up with the title. But the basic premise of the paper was if the antitrust actions against Microsoft were expected to actually make the operating software part of the computer business more competitive, then companies like Compaq was the biggest buyer of Windows software in the world, companies like Compaq should benefit. And their stock prices should go up at the very same time that Microsoft's stock price should go down if they're a monopolist and they're restricting output. In fact, even if they're not a monopolist and they're being attacked by the Department of Justice on an antitrust case, their stock's going to go down. So just when Microsoft's stock is negatively impacted, we should expect to see all these other computer shares go up, and vice versa. When Microsoft wins or advances, the government's case or investigation tails off, fades away, gets set back by the courts, then it goes in reverse, the other correlation. Okay, and there are a lot of other companies besides Compaq in the same boat. Companies like Intel, complementary producer, they certainly should sell more chips because there'll be more PCs sold if the software is more competitive, better priced, more functionality, and so forth. So we actually looked at the period 1991 to 1997. As you notice, this is pre-1998 when the big US v. Microsoft case, but there were other investigations publicly announced starting in 1991. We had a lot of events. We actually could compare this to what happened in the US v. Microsoft case thereafter, but our paper in 2000 was about the 91 to 97 period. And the basic expectation, of course, again, was that if you have a, if antitrust is efficient, essentially the Microsoft shares and the whole rest of the computer sector should go in opposite directions, essentially. If antitrust is inefficient, not expected to do the right thing, just sort of mess up the market, then the Microsoft and the computer sector should go the same way, either negative when the pro-enforcement, when the case against them or the investigation against them is going forward, and then it should be positive when there's a setback for the enforcement. Okay, so anyway, we run through this, and it turns out that Microsoft shares in the computer industry go exactly the same way. So the magnitude of the changes in Microsoft are higher, not surprisingly, than the rest of the computer sector, but in fact, surprisingly, the computer sector responds very, very, very positively in the same direction. All this is statistically significant. It was a very strong result. And so this indicates that investors were not impressed with the antitrust investigations of Microsoft, did not think it was going to make the market more competitive. That does not mean that Microsoft did not have a monopoly or that they liked Microsoft. It means that whatever was going to happen or expected to happen with the government's case, it was not going to make things better. Maybe they didn't think the DOJ had the heart to really follow through, whatever your theory. Now, if you follow this out of sample, meaning beyond what our study ran through, you find that this is exactly what happens in all the major events. that happens in the US v. Microsoft case. The whole computer sector goes with Microsoft. And, of course, we take Microsoft out of the computer sector when we're comparing these. But there were major disruptions in the NASDAQ, the tech sector, with many of these things, including, in particular, the April 2000, the findings of law was a very large Monday, Tuesday NASDAQ reaction. The entire NASDAQ index fell over 10% by noon on Tuesday, starting from Monday trading. So very large reactions in the wrong direction, so to speak, if you're at the Department of Justice and you're trying to impose efficient solutions. Now, these are the predators, by the way. See, there's the Department of Justice files, which these are secret Department of Justice files. I will crush Java like a bug. There's Bill Gates. He looks different today, don't we all? So now, in the how does this apply to the satellite case? Well, this has been attempted in the XM-Sirius merger. The data are not available. Why not? Well, you have some small companies that sell radios in this sector, and you can look at those. They don't exhibit any pattern related to the actual merger events. There are pure play problems. A lot of these radio vendors sell a lot of different types of devices, not just satellite radios, and so no results are essentially obtained. And the National Association of Broadcasters actually submitted an event study on this where they claim to have results. They actually got the event date wrong, so not a good outcome there. When you get when you adjust the actual event date, and by that I mean the date that the market finds out about the merger. The merger was announced officially on February 19th. There was actually trading on the rumor on February 16th, and so that's when the actual stock prices started to move, and you could see it in the stock prices of XM and Sirius, and you could also see it in the financial reports that were issued on February 16th. Anyway, you do the correct date, you don't get any results at all, and that's in my second paper. Anyway, okay, last thing to look at, interested party positions. Now, this will come as total intuition to everybody who works on Capitol Hill, but it's very powerful logic. Same logic as for financial event studies. You have to read these interested party positions carefully. There are some complexities that may be discovered. Of course, at higher hourly rates, consultants are always willing to do this. But it's a very accepted methodology by the antitrust authorities. That is to say, the antitrust agencies routinely examine merger effects by interviewing executives at companies that are interested in the merger, either rivals of the firms, customers of the merging firms, or vendors, suppliers of the merging firms. And the intuition is very strong. These are people who are expert in the market and in changes in the market and have in many cases invested some significant resources, either outside experts or developed internal strengths in evaluating how things like mergers will, in the spaces surrounding them, will affect their businesses. So they have an interest in getting this information and getting the information right. And of course, in any regulatory proceeding, regulators invite and pay attention to, with good reason, the comments filed by firms that are affected in some way by the merger. Again, these firms have an interest in finding out about what's going to happen and presenting their best case from their own firm's self-interest about what the policy should be. Now, this is an important fact in antitrust. It's been recognized by many prominent economists, including Baumel and Ordover up at Princeton, who wrote over 20 years ago about a joint venture. In fact, this was GM Toyota back in the 1980s, but the same is true for a merger. If the venture is likely to introduce economies or improve product quality, is sure to make life harder for the domestic rivals of the participants, who will then have to run correspondingly faster in order to stand still. Paradoxically, then and only then, when the venture is really beneficial, can rivals be relied on to denounce the undertaking as anti-competitive. Okay? So by looking at the rivals, and in fact Ford and Chrysler denounced the General Motors-Toyota combination there, the joint venture, as anti-competitive. The implication was it was highly pro-competitive. It was going to lower prices and improve product quality. So if you look at the XM-Sirius merger, you actually can get a lot of information from the interested policy positions. If you look at the rivals, particularly NAB and the National Association of Broadcasters, terrestrial radio, and NPR, terrestrial public radio, they both oppose, okay, the merger. By the way, NAB has one theory that says, well, we don't oppose it because it's going to make life more difficult for us in terms of competing for customers. We oppose it because it's going to make life more difficult for us in the advertising market. Well, there are lots of reasons that that's improbable, and lots of reasons why that's not inconsistent with opposing the merger because it would help competition for customers. But the NPR has no advertising, and they still oppose it. And so that sort of indicates that there is a consensus in opposing this for anti-competitive reasons. So that implies efficiency, that the firms, the direct rivals, are now opposed on record as opposing the merger. Why? Because they fear that a merger would actually effectively lower prices and increase quality of a rival. Okay? If they were convinced of the opposite, that the merger to monopoly would raise prices, that would be good for their business. Okay, and then you can run this through the distributors, automakers in favor. Yes, they filed, many of the automakers have filed policy positions favoring the merger. That does imply efficiency. The automakers consider this a complementary product. They don't want the price high because of monopoly. They want the product to be good, competitive, and compelling for customers, and priced right for customers. That helps sell that product and the cars. They get a cut too, of the product being sold. Retail radio sales, yes, the retailers are in favor of it. If it was creating a merger to monopoly and higher prices, they would be opposed to it. They don't get those higher prices. They get money on unit sales. They want more unit sales. They think the merger will do that. That is a pro-competitive implication. So this information is valuable. Yes, there's complexity. Should be interpreted carefully. But there's also an illusion of specificity to some of these formal economic models that I think is overdone and misleading. So I think it's commonsensical to include more information. And I think the regulators get this. This is a comment on the merger from a former FCC chairman, Mark Fowler. He talks about being visited by a broadcast industry lobbyist. He says, over-the-air broadcasters vehemently opposed the FCC's authorization of satellite television. And the lobbyist quickly launched into his preamble, we're all for competition, Mr. Chairman, but, meaning, according to Fowler, forget what I said up to the word but, and listen carefully now. In observing the broadcaster's intense negative reaction to the proposed merger of XM and Sirius, it struck me that little has changed in 26 years. Each year, the skies over Washington darken as the Learjets bring industry lobbyists to the latest battlefront against competition and its offshoot, mergers that enhance competition. Well, I mean, the point here is that he's inferring from the opposition of the rivals what the actual outcome would be from the merger. More competition and effectively lower prices, more quality. I think that's a correct and fundamentally accurate analysis. So, with that, I'll be happy to be quiet, turn off the volume, but answer questions if you have them. Yes?
I have a couple questions.
Yeah.
First of all, thinking about the issue of the market, I understand if you say if you look at all consumers have the choice of... If you look at all consumers have the choice of over-the-air radio, terrestrial radio, and satellite radio. Only 14 million choose satellite radio. So therefore, it seems like these two compete. But if you think about the 14 million that choose satellite radio, they've already chosen to pay $12.95 instead of $0.
Yeah.
Are those 14 million people a distinct market? Should we care about those subset of 14 million? And wouldn't they be more susceptible to a price increase? That's my question number one. My question number two is, I think your analysis that basically this is okay could apply to the satellite TV merger attempt of 5 years ago, EchoStar and DirecTV. Do you think the Justice Department was wrong to oppose that one? And if not, how would you differentiate these two situations?
Just on the satellite TV, there are actually quite a few different issues. Separately, I actually was asked by either side to be an expert in that case and ended up not being retained by any side. And then I went ahead and looked at it and wrote a piece for Barron's that you can get on my website if you want, favoring the merger. But a big part of that is the merger could have been extremely important in moving us off over-the-air television, just clearing the entire so-called digital TV band and putting everything on satellite. The fact that we are not going 100% to satellite and cable when we have an opportunity to do that right now in the so-called digital TV transition is a huge public policy blunder, in my opinion. And we could have taken ourselves in the right direction 5 years ago with that merger. Now, the biggest difference right off the bat with the satellite TV versus satellite radio, the big anti-competitive part of the satellite TV merger was that there are parts of the country that don't have cable. And so there was a 2-to-1 merger without local cable. And so that was a big part of what happened in that merger on the regulatory side. That was significant enough that that was where the battleground was, and satellite TV lost. There was just...
Over-the-air TV, broadcast TV.
What's that?
For those parts, doesn't over-the-air TV, broadcast TV, be just like
No. In fact, I write a lot about the rules on that. The broadcast television does not compete with satellite with the 150 channel cable and satellite that are established now. In fact, are dominant now. Remember, that's a dominant technology now. 97 million households out of 113 million households, or thereabouts, have satellite, not over-the-air broadcasting, as their primary TV source. Okay, satellite radio is 14 million.
But it has 150 channels.
It has a big package, yes, but it has no market scope. And so you can't put that, and in fact, when cable was very small, in fact, up to 50% of U.S. households, we had a whole different rule on what constituted competition. And what constituted competition was over-the-air television with cable. When cable got to be dominant, we actually, in the 1992 Cable Act, we did away with the over-the-air television competition rule. Effective competition in cable since 1992 has involved another multi-channel service provider in there. Okay, up till 1992, 3 or 6 over-the-air television did compete because cable was thought to be a growing nascent service where satellite radio is today. So if you actually go apples to apples on that, no, you don't have the same. You certainly don't have the same 2-to-1 merger anywhere in the country. You have you do have much more competition in terms of substitutability between the products. And nobody really disagrees with that. I mean, maybe the broadcasters are trying to circle this off, but I think in terms of the actual, if you look out to the marketplace and see how people dial this in, it's the idea that cable and broadcast television were good substitutes was, by 1992 anyway, not thought to be plausible. Whereas, people certainly take it seriously now, and in fact, I think it's a clearly common sense test. What else was the?
14 million satellite radio subscribers.
Oh, yeah, their market. Well, you see, I think the parties are actually arguing something similar to what you say. The merging parties. Why? Because it's not that the merging party, that the satellite customers are now their own market. It's that each set of customers. In other words, once you buy an XM radio, then XM's your company. And if you want to switch out, you've got to buy a Sirius radio. Now, the way it happens is that there's no switching cost to go to AM/FM. But there's another big switching cost to go to the other satellite company. So if you're going to separate down to the individual markets, you get down into the situation where they're separate markets. And in fact, many of the Wall Street people argue exactly that. This is outside the merging parties. They will say, look, the real competition between the companies now is to get automobile makers to put them in the cars. This is the way they're actually selling most of the units. When you buy a car, now guess what? The car makers pick one of the two companies. I think one of the car makers, Hyundai if I'm not mistaken, will actually give you a choice. But all the other ones go with one or the other. And the idea is people are not really going to one car maker or the other based upon satellite radio. You know, they're just picking their car, and then they get satellite radio or not. So a lot of that stuff about, you know, the market's already sort of gone in that direction. And by the way, a lot of that is the fact that there is so much other competition out there. The idea that, I mean, the car makers say, look, we'll give people an MP3 plug now. You know, you can get the iPod plugs, you can get HD radios put in, you can get satellite radios put in. You know, there's a lot of audio stuff you can plug in there now, in addition to GPS and other electronics. XM versus Sirius is not the big issue. It's MP3s versus AM/FM versus, you know, these other plugins. That's the way the market has gone. So that's actually an argument in favor of the merger, in my opinion. Yes.
What is the relationship between the number of subscribers, XM-Sirius subscribers, and the actual value? Is there a relationship there? In other words, they're both valued at $9 billion. How many more subscribers would it take?
Well, you can divide through. I mean, they're up to about 16 million subscribers about now. You can divide through. I mean, they're, you know, roughly they're about $10 billion. I haven't seen, I mean, you know, the values fluctuate. You know, divide 16 million customers by $10 billion, and you got, what, $600 a subscriber, something like that. But, you know, they're growing very rapidly. The whole thing is based upon projected growth. And
when will they be actually valued at $16 billion? Is there a number?
oh, they may never. I mean, you know, that doesn't mean they're going to exit. I mean, it's just, you know, if they had to do over again, they probably wouldn't put $16 billion down to have a $10 billion business. So there's a lot of sunk costs there, and you know, in the future they hope to have more than a $9 or $10 billion business. That's what the merger's about, and they hope to survive. I mean, they hope not to go to zero. And you know, I think you know, it's been a very tough go. Satellites are not cheap. That's what they found out. And selling new radios, new subscriptions, not cheap against a free product like AM/FM. So and the MP3s. By the way, if you read the financial press, they really think that the iPod is, you know, a huge factor in it, or your cell phone. The fact you get cell phone audio service, you get, you know, you have AM/FM receivers in cell phones now too, and MP3 players, and they think that all this other audio stuff out there has really hurt satellite radio. And satellite, you can see the satellite radio stock prices come down in the last 4 years, quite a bit. I mean, right through the iPod boom, and that, I mean, that's what the financial analysts track that and draw that conclusion. There's a causation there. And so that's why I say, you know, ignoring the financial markets in favor of these, you know, formulaic tests is very problematic in terms of defining the market. The market is actually changing. People on Wall Street are watching this carefully. The firms obviously are watching it very carefully. And, you know, if you try to tap into that, you'll learn a lot more about the competition that's taking place.
When do you expect the Justice Department to either approve or reject the merger? And
that's my question for you. I don't know.
And are you surprised by the time it's taken them to review the merger?
Well, watch the Kramer video. That's my opinion. Only I'm not as constrained as Kramer, right? No, but I really don't have an insight. I don't have it wired.
I just have a quick question.
Yeah.
You know, your numbers on financial markets,
Yeah.
they indicate that markets value regular broadcasters at 4 times their profits, but they value XM and digital broadcasts at like 6 times profits. So to me, it implies that markets actually expect much higher rate growth.
Well, sure. I mean, look at the timeline.
So I mean, right, but I mean,
terrestrial radio's been there since November 2nd, 1920.
Well, but I mean, then it's not inconsistent with the idea. I mean, it's an open question whether it's, will come from, profits that will be higher due to monopolistic, monopoly, or the subscribers growth. It's not inconsistent, in other words, with that. It leaves the question open.
Well, this is one of the tricks that you actually get away from when you look at the full financial picture. Just because you have a high capitalization of current profits doesn't mean anything by itself. You have to look at the total investment required to get there. If you're not making higher than competitive returns in your total investment, then that says something quite important about the level of competition you're facing. Yes, you can include sunk costs. Yes, you can. Because you can't get there without those costs. No, you're on a different margin. You're saying that believe me, you're saying that for other purposes, those are not going to be taken into account. Now, in the long run, they are taken into account. In the long run, they're not sunk. They have to reinvest in these satellites over time with maintenance and new satellites. But that's not the point I'm making, and it's not the point you should be making. The question is, are you making competitive profits or monopoly profits? Now, to find that question, you have to understand about total costs. That's what the profit question is. Total costs. If you say, well, you're making big cash flows, that's a Steve Martin joke. Steve Martin says, well, how do you make $5 million? He says, I'll tell you how to make $5 million. Let's start with $10 million. Okay? Now, that's what they've done in satellite radio. That's not a monopoly profit. Okay? Profits are calculated on average returns, not marginal returns. They are sunk in this, and so that has to do with how decisions are made looking forward. Absolutely, but to figure out where the profitability of the market is, you have to include those costs. It's not optional. If you're going to invest in things that have great marginal returns but negative average returns, you're going to lose a lot of money.
Are there any more questions? Okay. Seeing none, thank you all for coming to the presentation.